Okay, what's up, everybody? This is Sunko, the Korean Bro. Today's 2024, February 6th, and what I'm going to do is read interesting articles and then read about Tesla articles at last because recently I know that there's a bearish trend with Tesla chart, and I know things are not going great with Tesla, and that um, Tesla is struggling with its sales. On top of that, you know, not Mark Zuckerberg, but like, what was the CEO of Tesla? Mm, anyway, this guy, as far as I know, had like a drug party or something, and then mm, anyway, he made an accident, uh, and because of that, probably further drop of value is expected short term. In the long term, of course, it's gonna go up, but in the short term, it's highly likely that it's gonna go down. Well, let's see. First things first, Amazon did this for the first time in 5 years in 2023. Here's why it makes the stock a buy. Amazon's profits soared last year to more than $30 billion, recovering from a year earlier loss. The company has revamped its core structure, and the efforts are bearing fruit. Hmm. Okay, Amazon spent the past couple of years making moves to fight rising inflation in the near term, but more importantly, these actions should help power strong earnings over time. The e-commerce and cloud computing company Coach focused on efficiency across its fulfillment network, invested heavily in growth areas like technology infrastructure. The efforts have borne fruit over the past few quarters. After reporting its first annual loss in nearly a decade in 2022, Amazon sprung back into action with a $30 billion profit last year. The list of positive financial metrics is long, but one in particular stands out. In fact, it's something Amazon achieved for the first time in 5 years. It makes you stock a buy right now, even after last year's double-digit shares price gain. Let's take a closer look. Okay, as I mentioned above, Amazon's primary businesses are e-commerce and cloud computing. Through its Amazon Web Services, e-commerce sales in North America uh, and internationally rose by double digits last year. In the fourth quarter, did AWS revenue, and now Amazon is on the way to maximizing its profit on those sales by tackling a key metric. The cost to serve last year lowered the metric on a per unit basis worldwide for the first time since 2018. US, for example, cost served declined more than 45 cents per unit in 2023 compared to the previous year. This is key for a couple of reasons. First, on its own, a lower cost serve cuts down on expenses, which is always positive for a business. Second, a lower cost serve means Amazon can invest their money saved in speeding up delivery and offering a wider selection of products at lower average selling prices. Lower selling prices and faster delivery of a top selection of items at lower prices should drive more people to sign up for its Prime membership program, meaning they will keep coming back. So the company says recent growth in its essential sales, items like healthcare and personal care products, proves that fast delivery times are winning over customers. Shoppers generally need these products right away. And Amazon isn't done lowering its cost serve. The company says it has evaluated its fulfillment network and has identified several areas where it can continue cutting costs and supercharging delivery, which will be a focus in 2024. So, how is Amazon lowering costs? If you're wondering how Amazon was able to make so much progress in cost serve, major factor in this has to do with the structure of its fulfillment network. Structure of its fulfillment network. Last year, the company shifted from a national model in the US to a regional one, bringing inventory closer to the customer. This has allowed the company to reduce transport time. It means shoppers receive their orders quicker, a win for Amazon and the customer. I said above that This makes the stock a buy, but this isn't the only reason to like it. The company has a solid earnings track record, showed that after difficult times, it can quickly recover and grow, and remains a leader in the high growth markets of e-commerce and cloud computing. On top of these, Amazon shares trading for 40 times forward earnings estimate look reasonably priced for a growth stock, offering investors a kind of package. So improvement in coach serve is actually usually a great reason to buy this stock, but considering the complete Amazon picture, this might be just icing on the cake. Mm. So all in all, they lowered coach serve, and it practically means that low expenses on delivering products to customers, and products can be shipped to customers a lot quicker, which is a good thing because customers can order a lot more and can get what they want a lot faster. And along with that, Amazon can deliver that products with not cheap price, but like uh, with more efficiency. It's more in control. Uh, and their main strategy was that originally their warehouse thingy was located far away from uh far away from where people live, but like it's been moved to like near hometown, like near where people live. Like it's been like regionalized. So okay, two magnificent dividend growth stocks load up on right now. What would they be? AV, S&P Global. Alphabet's ad sales disappointed Wall Street. The company's revenue and earnings growth were stellar. Alphabet is a dominant business for a number of reasons. Okay. Well, revenue up 13% and diluted APS surging 56% compared to quarter four 2022. It makes you scratch your head and wonder why your stock is down. But it was Alphabet's advertising revenue that missed analyst expectations. Seeing as how digital ads made up 76% of the company's overall sales in 2023, it's clear that disappointment here would lead to a negative reaction from the market. Ad revenue rose by 11% in the fourth quarter, so there was still a solid gain. This was driven by strength in the retail sector as well as in the Asia Pacific region. As we entered 2024 with advertising revenue that was more than $100 billion higher than 2019, we remain focused on sustaining healthy growth on this larger base. CFO Ruth Power said on the quarter four 2023 earnings call. YouTube produced $9.2 billion in sales, up 16% year over year. Just missed Wall Street expectation by measly $10 million. Management also mentioned there were more than 2 billion monthly active users on the platform. There are an average of 70 billion shorts being viewed with daily. Engagement doesn't seem to be a problem. It's easy to follow you heard and immediately lean towards selling your shares, but there's no need for investors to panic. Revenue for Alphabet actually increased at its fastest pace since the first quarter of 2022. Mm. Okay, it's easy to follow you heard and immediately lean towards selling your shares, but there's no need for investors to panic. Revenue for Alphabet actually increased at its fast pace since the first quarter of 2022. So, an elite company, don't let the market negative reaction to Alphabet's latest earnings distract you from the factors that truly matter. As long-term investor, it's best not to get caught up with what happens during a 3 month period. There are so many wonderful qualities that make Alphabet an elite company. When the 91% share of the global market, search has a monopoly position. The fears about the rise of ChatGPT and its integration with Microsoft's Bing search engine have proven to be overblown. Alphabet has a pristine financial position. Its operating margin in quarter four came in at 27%, a notable expansion from a 24% the prior year period. Ongoing cost cuts, like the latest layoffs of 6% of the company's workforce, are boosting profitability. Alphabet also ended 2023 with $111 billion of cash equivalent, marketable securities on the balance sheet, compared to long-term debt of $13 million. This puts the business in a favorable position to continue investing heavily in growth initiatives. One such area is in the cloud. Google Cloud reported 26% revenue growth and a 9% operating margin last quarter. With the recent launch of generative AI tool Gemini, Google Cloud has a potentially meaningful revenue driver. It licenses this technology to clients. The cloud team is intensely focused on bringing the benefits of Gemini, our industry-leading AI technology, hmm, to enterprises and governments globally. Benefits of Gemini, our industry-leading AI technology, to enterprises and governments globally, and we're gratified with the level of engagement. Port highlighted. There's no shortage of reasons to be bullish about this business. Investors should take advantage of recently deep to buy the stock. Okay, Alphabet is here to stay. Cloud is a long-term opportunity. Okay, here you go. Is Alphabet business in trouble? Alphabet's largest revenue driver is advertising, which primarily stems from Google and YouTube. In addition to ads, Alphabet also has a fast-growing cloud computing operation, as well as a service business, which includes purchases through its App Store and hardware devices. Despite its diversified business, the overwhelming majority of Alphabet's operating profits come from the advertising business. For this reason, it's pretty consistent that investors keep a close eye on the performance of Alphabet's advertising services. For the period ended December 31st, Alphabet generated $65.5 billion in advertising revenue, up 11% year over year. And for the full year 2023, advertising revenue was up just 6% annually. Competition in the advertising space has risen dramatically over the last couple of years. Platforms such as TikTok and Meta platforms, owned Facebook and Instagram, are all gaining momentum across different demographic segments. Furthermore, Amazon's advertising business is also making significant inroads in the space. To make matters more complex, the macroeconomic environment has been plagued by lingering inflation and high borrowing costs. Subsequently, businesses of all sizes have been much more careful with their budgets and where to allocate capital. The combination of rising competition and tighter budgets has undoubtedly impacted Alphabet's core business, from revenue to profits. Given this dynamic, some investors may be wondering if it's time to move on from Alphabet. However, by zooming out and look at the bigger picture, the long-term investment thesis around Alphabet goes far beyond its ad business. The cloud is a long-term opportunity. One theme that underscores the best business is expanding outside your legacy products. For example, Microsoft evolved from being a developer of the Windows operating system to a giant corporation spanning gaming, cloud computing, hardware devices. I see Alphabet at a similar point in life cycle. Given the challenging facing its ad business, the company needs to prove that it has more to offer. Well, it trails Amazon and Microsoft by notable margin. Alphabet's cloud operation is quickly becoming an important pillar for the business. So in 2023, Alphabet's cloud business grew 26% over a year to $33 billion. Furthermore, the cloud unit generated $1.7 billion of operating income compared to a loss of $1.9 billion in 2022. Not only did the Google Cloud Platform's growth outpace that of Microsoft Azure and Amazon Web Services, but it has swung to a profitable segment in just 1 year. Some contributors to Google Cloud's growth include its unique leverage of artificial intelligence applications and cybersecurity use cases. The intersection of AI and cybersecurity is important, and Alphabet's strategic acquisition in these industries over the last couple of years are already yielding accelerating growth and profits. So, should you buy this? As of this writing, Alphabet stock trades at a forward price earnings multiple of 21, essentially in line with that of the S&P 500. Nevertheless, compared to historical averages, its 4 P/E level doesn't imply a rock bottom valuation by any means. While the legacy ad business is facing some existential competition, it's too early to tell if the accelerating growth will be an ongoing theme. Moreover, the prospects of the cloud business look encouraging. And I view Alphabet as an on-the-radar AI opportunity with robust long-term potential. Okay, here again we have Amazon again and Pinterest second. So let's read Amazon again, okay? Read I'm reading this like one another definitely has come a long way in the last 3 decades since Jeff Bezos started an online business selling books from the garage. Fast forward to today, and Amazon controls a wide range family of businesses and income streams, including one of the world's largest e-commerce platforms, the world's largest cloud infrastructure business, subscription services, advertising services, and more. Like many growth-oriented stocks, Amazon has some bumpy quarters in the turbulent macro landscape brought about by steep economic headwinds of the pandemic. This man, that management undertook aggressive measures to coach return to sustained profitability, including a series of widely reported layoffs. So these difficult operating decisions, you know, have paid off. And while individual enterprise customer spending is still in the flux, Amazon appears to be winning in tough environment. The company released its results for the fourth quarter and full year 2023 on February 1st, promptly giving shares a nice single-digit boost today. Shares are up by approximately 41% over the trailing 12 months. The S&P 500 has delivered a gain of less than half the amount in the same period. In 2023, Amazon pulled in total net sales of $575 billion, up 12% from 2022, and net income of $30 billion. The bottom line figure was a noticeable improvement from mm, mm, yeah. So let's see if there's any articles about Tesla. And now it's going down again. Tesla stock approaches 8-month low amid scrutiny of directors' ties to Musk. Tesla shares fell after a new report about blurry personal and professional boundaries between CEO Elon Musk and the company's board of directors. Additionally, German software giant SAP said it would stop purchasing Tesla vehicles for its corporate fleet. Reports added to the string of negative press for Tesla, including a Delaware court striking down Musk's 2018 compensation package. Shares of Tesla fell Monday morning after the Wall Street Journal on Saturday outlined the blurry personal and professional boundaries between Chief Executive Elon Musk and directors responsible for overseeing his work. So several current or former directors at Tesla and SpaceX attended parties with him. Several current or former directors at Tesla and SpaceX attended parties with him, go on exotic vacations and hang out at a Burning Man, the Nevada Arts and Music Festival, according to the Journal. They also have amassed shares worth hundreds of millions of dollars from their seats over the years, significantly more than what board members at other companies make for their services. The report comes just a day after a Delaware court struck down Musk's 2018 compensation package, which was valued at up to $555.8 billion. The process leading to the approval of Musk's compensation plan was deeply flawed, wrote Chancellor Kathleen McCormick, who cited his professional and personal ties to the directors with whom he negotiated a pay package. In response, Musk said in post on X that Tesla would hold a shareholder vote on transferring its state of incorporation taxes from Delaware. The company relocated its corporate headquarters to Austin, Texas, from Palo Alto, California. In 2021, after much criticized California's tax and regulatory environment, adding to the bad news for Tesla investors Monday, German software giant SAP will stop purchasing Tesla vehicles for its corporate fleet due to unpredictable deliveries and price swings, according to German newspaper Hand. It follows German rental companies, which in December dropped Tesla from its fleet because the company's price cuts on new vehicles were devaluing its used fleet. U.S. rental company Harris said in January they would reduce the size of its Tesla and electric vehicle fleet due to weak demand and price instability. So okay, I get it. So the recent price drop is caused from two factors. One will be him getting along with board of directors, and the second would be the fact that SAP decided not to buy vehicles from Tesla because what they said is that its price um, changes so many times, so it's hard for them to, plan, further ahead. So recent, so in the near term, the price of Tesla uh, will go down, of course. When it's short in the long term, it's gonna go up again. So I'll see what I have to do. Okay. Anyway, this is it, and I'm gonna see you tomorrow. Okay, bye bye. Every day, good night. Not every day, tonight. Go have a good night. Okay, bye bye.